I mean, you're already kind of diversified outside of the more traditional things. Why diversify within a diversification?
Because even in sports, you need to build a resilient portfolio to any economic downturns, changes. We've lived through it. We know how things work. What's great about diversifying it is sports adjacencies and the thematic investments in sports really encompass a lot of different markets. So we talked about real estate in the sports vertical. Think about media and broadcasting rights. That's a massive one right there. When people couldn't fill the stands during COVID to go to a stadium, they sure were paying attention to media and broadcasting rights. It skyrocketed. Same thing with like memorabilia sales. They went through the roof at that time. So if you diversify across each one of these kind of verticals across sports, so call it sports real estate, medicine, tech, fan experience and engagement, down to actual high performance itself, each one of those verticals, the totality of them makes it very recession-proof and very resilient.
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Nick, thanks for coming on the podcast.
Thank you for having me. Really appreciate it.
Oh, absolutely. Looking forward to this. We were talking in the green room, both hockey fans and come from competing cities, but we won't let that get between us, I promise. All joking aside, why don't you give a short intro to the audience and tell us who you are?
Sure. I'm a former athlete, born and raised in Minnesota. I live in Denver now. I've kind of made the transition out of sport to being in the business ecosystem where I was a founder of a couple different startups to then running different SPVs and investment organizations, being an angel investor, an LP in funds, to ultimately being a general partner of funds. That's where I'm at today.
Wow. Okay. When I said surfacey, let's dig into that a little bit.
Sure.
Okay. So sports. Okay, Minnesota. I mean, we're from Winnipeg. Very similar climates. Why don't you tell me kind of what drew you into sports and what sports were those?
Yeah, even though in Minnesota I was not a hockey guy, of course, to play pond hockey, you have to. When you're from Minnesota, but I was a wrestler and a football player, and what drew me into athletics is it's something that's always been part of my persona, something that I've always had my entire life, and really diving into athletics kind of allowed me to, I think, develop a lot of the necessary skills to kind of help me in business and just other aspects of life and the social environment, teamwork, and did that as an athlete. Like I said, three-sport athlete in high school, then played football for NDSU, and then actually transitioning from there. Oddly enough, I actually tore my ACL, and I killed the football dream. And what's funny is I'm about 6 foot 205, so I'm a little guy, when it comes to football players. So there would have been no way that I would have ever played in the league, but you couldn't have convinced me that when I was a college prima donna. And then after tearing my ACL, that made me pivot, and I actually went into MMA for quite a few years. Had a great career there. Ended up winning a national title for jiu-jitsu, competing at Worlds and taking fifth, and had a really great career on that side.
Wow. Okay, lots in there. I actually just had Bruce Buffer on the podcast a couple weeks ago. Yeah, I mean, we could have a whole conversation about branding and that whole "it's time." Like,
Absolutely.
just
Yep.
listening to that guy. I mean, just how it's iconic, right? So I understand the transition for wrestling and then obviously jujitsu and things like that. I mean, it's my podcast. I can talk about this if I want, but no, I love martial arts. I was also involved in that heavily when I was a kid. Speak to me about how one starts to, I imagine you said you wrestled, and then when did the martial arts play come into it? And then how did you make that transition into the ring?
So what's interesting is I actually had zero interest in doing that. So it wasn't something that I grew up and said, "Oh my gosh, MMA is great. I want to do this." I thought it was cool, of course, being a kid and watching some of the greats compete. But for me, it was actually when I tore my ACL, I was kind of in my woe is me phase and not sure, because for me as an athlete being injured, when everything stops, you really feel like you're losing your identity. And you don't really know that. And people kind of laugh at that, but it's really true when you're an athlete and you just can't compete anymore. It's the one thing that you've been driving your whole life, and then it's done. And it literally just stops that day. There's no transition out of it. You don't talk to agents or financial advisors or anything past that. It is done. And so it was actually a former wrestling coach who said, "Hey, Nick, you should really try MMA." And he was actually competing a little bit. I said, "No, I really don't want to get punched in the face. It sounds absolutely awful. No, thanks." And he said, just come to one practice and try it out and you'll see. I'm like, okay. So sure enough, I went to one practice, and I mean, it's literally like the movie Fight Club for me. I was hooked. I'm like, this is unbelievable. And so I never looked back. So I trained for about a year and a half before actually stepping in the cage for the first time, and it went great.
Okay, so was that like local meetups and things like that? Or, I mean,
Yep. So we had a team. So in Minnesota, there's actually a very good MMA scene across Minnesota. But I did a local circuit around there, fought in uh, for across Minnesota, North Dakota, South Dakota, then kind of did a bunch of
wow.
different traveling shows through California, Texas, fill in the gap. So I ended up ending my career with 14 total fights, and then competed in jiu-jitsu in many different tournaments. Had a very good record on there, over 30 wins, and then ultimately going to Worlds.
Wow. So was the jujitsu part of the MMA pathway, or was that before, after, during?
It was part of it for me, and honestly, as a wrestler, it's really hard to learn to be comfortable on your back, and so that took a lot of time, but that was definitely the strength for me was the ground game.
It's interesting you say that. My nephew is 14 and he's big into jujitsu. And of course, now they're trying to teach him the wrestling component where you're not supposed to be on your back, right? So he's having a hard time adjusting.
It
Um,
is different. It is really different.
so MMA, and then what happened after that? So how did you formally transition out of that part and then into, I guess, was it business? I can't remember what you had said there.
Yeah, because for me, I knew early on in my career that I couldn't do it forever. There's a finite amount of time that you can really compete in this sport. It's a very physical sport, and frankly, not to mean this in a horrible way, but if you look around, typically a lot of the folks that are competing in MMA, these are the first folks that are leaving, the nest, that are graduating high school for the first time in their families, graduating college for the first time in their family. So I knew I wanted to at least have a long career past MMA. So I studied. I continued actually getting my degree at North Dakota State. From there, I actually went into physiology. So I was blessed enough to have doors open for me where I worked with NFL, NHL teams, and oddly enough, after working with those teams, I got to see all the tech, all the cool things and I was exposed to a lot of it actually with our team alone, but there's just so much stuff that's out there in the sports tech, the entourage of people that are around you helping you in your sport, to the medical side of things. There's so much that general population doesn't see and that they don't get to experience. And so I really kind of piqued my interest on a path of commercialization of how do we scale this? How do we get it out to the masses? And so that's where I jumped into the founder seat myself. And so worked in a bunch of different early stage companies that kind of were the middle ground between sports medicine to sports tech. And then it just kind of flourished from there.
Can you back up a second there? Like define tech in that context.
Yeah. So everything that I really started to touch was kind of on the middle ground between sports medicine and sports tech. So what I mean by that is this convergence of monitoring somebody's human performance, and then ultimately, what does that do for health outcomes? What does that do for longevity in sport? And what does that do for actual sport prescriptions? So, let's say we'll go back to the hockey example, right? Since Winnipeg and Minnesota, so on hockey, what I would do with teams is we'd literally look at the time on ice. We'd look at what their heart rates were at based on how long they were in the red zone, how many minutes should they actually be playing in a game, what is the total time allocation and actual output they're doing during a shift, and then how do we take that to make it prescriptive in the weight room, in conditioning drills, and then in practice across the field.
Okay, no, that's cool. What year was this?
Oh man, this would have been 2006 to
Wow.
2006 2009.
Okay, so you guys were definitely ahead of your time then.
Yeah, it's one of those where definitely got ahead of the time, and it's funny. In my first company had a good exit, but now looking where things are at now, there's a lot that have emerged since. I'm like, oh man, there's so much more that can be done. It's pretty exciting.
Well, yeah, I mean, sometimes you say it's cool to be first, and I've been first in that kind of context, but then you look like 10, 15 years later where it's just kind of normal, right?
Yeah.
It's like, no, wait, I was innovating this back then, and now it's like included as a package. Like, what's going on here?
And it's so funny that I've changed my mindset on that too, from being kind of in the startup founder mode and saying, how do you create a unicorn and $1 billion idea versus now being on the VC side, investor side of the spectrum. I actually, in my day to day, don't hunt for unicorns. What I look for is groups that are making 1% difference because I firsthand know how hard it is and how close to bankrupting a company you can be when you are the innovator. Everything has to line up perfectly. Otherwise, it doesn't happen. So if you go tell, like, for instance, a sports medicine physician, they're amazing population, very innovative group. But if you tell them, here's what we're going to do, it's going to be the best thing for your athletes. And they say, cool, how do I bill for it? You're like, you don't yet. This is brand new. They're like, no, it just doesn't happen. Right. So it absolutely has to fit within the market and actually meet the propensity of the market where it's at for it to work. So I look for product market fit and things that are 1% better than the norm, we'll call it.
Yeah, let's dig into that last point for a little bit because it is a business podcast, and that innovation piece is kind of what drives an entrepreneur's spirit, I think. I mean, I don't want to call it chasing shiny objects necessarily because I think innovation drives society. But, tell us about what it's like being at that, hair on fire, everything's taken off, and yet you're still one hair away from bankruptcy.
It sucks. That's what it's like. There's no other way to say it. It's I will tell you from both I've had to bankrupt a company and I've had successful lives that both are terrible. Like anybody that says, I exited my company, it was so great, follow me for more details. No, you're lying. It's awful. It is a real-time business prostate exam and looking under every single possible thing you can possibly have in business. And it's a big evaluation of you as an individual, your product, and your growth trajectory. And it's the same thing on the other side of the spectrum. If you don't have product market fit and you don't have people that are buying your product, it can be death by a thousand paper cuts slowly of really making sure you don't have the market adoption and you're clawing back every day you can. And ultimately it may not be successful.
My business coach, lots of people have heard of him, JT Fox, but he has a book coming out in February called Business is War. Not intentionally plugging it, but the theme of that is that we learn from failure, right? And he's had me doing an exercise this week to, reach out to 9 people of differing levels of success and say, what was one failure that really taught you something and made you who you are today? Can you dig out anything out of like you mentioned, bankrupting a business? What would you say to that? What's the lesson from that failure?
I don't know if this podcast is long enough for me to outline all the different things. You learn a lot more from your failures than you do your successes. And that's really the bottom line to it. And I love if you look at the sports ecosystems, and that's the business I'm in. You look at guys like Kobe, Jordan. Of course, they have some of the winningest records and they have amazing credentials behind them. You look at their losses, and they're also leading the loser board across the board. You have to take the shots. And so those losses shape you. For me in business, a lot of the losses that I've experienced have number one taught me that I cannot be a one man show. You need to have a team to survive. And it goes the same thing analogy once again in sports. You can't have the quarterback also be the running back, also be the wide receiver, also be the offensive line. You have people there for a reason that have different credentials and specialties. And so that's one thing that you learn hard from a failure, at least I did. And that shaped me really well. I would say another is above all is protect the principal, right? It's making sure that you are making sure that you're protecting cash, that you are staying to your thesis and you're not following the shiny object. And then last but not least, I would say another big one is just the separation between partners and employees. I think a lot of people really like to say, these are my first employees. This is fantastic. And they treat them like partners. The reality is they are there because they need to provide for their families. And so they're never going to carry the North Star like a founder will. The founder's job to project that North Star and give them a guiding light to go to, but don't ever have the faith that there's there as a partner. So you need to have that separation there to know the difference and then rely on them differently.
That last point is gold. If there's any entrepreneurs or business people listening to this podcast, like literally write down what Nick just said. Um, Too many of us, especially when you're in a smaller company. I mean, I have like 18 team members, so small to medium, or maybe just small, but certainly more than 2 team members. And I'm guilty of it too in asking my staff what they not what they think. I mean, I want to elicit an opinion, but you shouldn't be asking what should I do because it's unfair to that staff member. Like again, think of a coaching environment, right? You're not going to ask somebody who hasn't done what you have done, who doesn't know what to do in that situation, that question, right? They're either going to tell you what you want to hear. They're going to be digging into some random thing they might have heard on social media. You want to be asking those questions of people who've actually done it. If you want to become a millionaire, then ask a millionaire, how did you fail? How did you succeed? So I've been guilty of it. Just, hey, staff, what do you think I should do with this major business decision? And I think the lesson there is emotional intelligence. Look at your financials, take a deep breath, and then you're the leader. You got to lead, you got to live with the consequences. Obviously, do your left brain analysis on it. But yeah, that is huge, Nick. Thanks for that.
Absolutely. You're spot on as well.
Yeah, no. Okay. So you had these failures. What was next after that? Because I know you said VC type stuff. Like I want to kind of hear the story and transition into how that shift, that even a mindset shift was made.
Yeah. So the mindset shift for me was literally looking at what went wrong and saying, how can I help others avoid this? And the underlying theme that I've always carried with me is kind of all the way back to the root of when I transitioned out of sport of how do I reach the masses with it? So, I've worked with people on a one-to-one scale and it's great. I want to work with tens of thousands. I want to work with millions, really impact lives. And I guess the badge that I was carry on me with that to do that type of expansion scale is just do good things and the money will follow. And so if you're doing right by others, you can scale really quickly. And so one thing that I found is I can help other founders avoid these pitfalls. Here's something that I can do good for the world and kind of keep things moving. And so by doing that, I frankly just had some doors open for me by some phenomenal individuals where then I got involved running different SPVs, evaluating deals. I kind of dabbled across real estate and hospitality, specifically looking at like medical real estate and like sports medicine complexes and designing like bricks and mortar athletic facilities. Then from there, kept on that transition path, said, all right, how about just direct investing in startups? So being an angel investor, an LP in funds that are going out there. And then finally, really taking the GP role on where I was helping with a nonprofit landscape, helping companies at a 0 to 1 phase through an accelerator, help them get their product to market, help them find product market fit, and then really scale from there.
Okay, let's dissect that a little bit because there's a lot of acronyms throwing around there, and one I actually admit I don't know. SPV. You mentioned that a couple of times.
Yes. So special purpose vehicle. So that is basically an LLC or a unit formed to basically bring in capital that can then be placed in a certain project. So for example, let's say you and I say we get off this podcast and you're like, "Hey, I got a multifamily unit that we should buy." Cool. So typically you would form an SPV or form a business unit together that then you're throwing your capital in and then managing the project.
Okay. So it's not necessarily, I mean, a syndication could be one SPV, I guess, but on a larger scale. But a corporation could be as well that you're putting said asset into. Would that be accurate?
That's accurate. Yeah, it just depends on the form that you're and the asset that you're investing in, and last the number of partners that you're going to take on. Typically, if it's like a partnership, you can spin up a small LLC and get going, right? But if it's something where you're going to have 90, 250 investors, that's where you go to those syndications and different business units to do that.
Okay. So typically, when I hear terms like GPLP, obviously general partner, limited partner, it is in my real estate syndication type deals. But of course, you can use the LPGP structure in buying businesses, private equity, all sorts of things. In what context are you speaking about this here?
Most of mine are in funds directly. So this would be in funds, private equity, and VC that are placing in emerging companies or established companies.
Okay, can you expand on that a little bit for the audience?
Yeah. So I guess let's divide the two. So venture capital, if you look at a venture capital firm, people can invest into venture capital funds. Usually there's a minimum dollar in to do that. And venture capital typically what it does is it's going to invest in more riskier, and this is I would again underline typically, you're investing in riskier or earlier stage deals. And what that means is you're basically taking out of 10 companies, 9 may fail, but one's going to return the entire fund. And so, really, you're looking for that unicorn. You're going out there hunting for those that can provide the ultimate return, high returns, so that they return the fund and provide, north of a 30% return to their limited partners. The other side of it, private equity, is a little bit more stable. Usually, they're looking for change of control. So you're buying up 51% of an established business unit or a certain asset type, and then you're going in there to actually put operational skills to work and to get things going. So, horse of a different color between the two. You're usually either passive, and then they'll bring on people to potentially help or advisors. And then private equities, you're getting your hands dirty. You're taking part of the operation, getting things going. And because it's less risk, typically you're seeing like 25 to 30% returns. So it's a different
Right.
return profile.
Okay. Yeah, no, I'm starting to think about positioning myself to do the PE game this year in 2025 as well. More as like maybe a platform portfolio. I'm not quite sure, but definitely because I have a large property management company, my expertise is kind of home services. So that's where I'm focusing my attention on. For you, VC versus PE, which sandbox do you prefer to play in?
I actually shoot the gap between the two.
Oh, interesting.
Yeah.
Okay.
And
Explain.
so my firm's called Champion Venture Partners. And so we actually invest across the sports asset class. And so people always, when they think of sports, they think the big five, right? They're thinking the MLS, MLB, your typical big deals. Like if you see private equity, obviously just got recently allowed for the NFL, and that obviously caused a big stir. So everybody thinks of the big leagues and teams, but the reality is a lot of the money is made and the upside is down the downstream from the teams and leagues. So I'm talking about digital products with CD, fan experience, media and broadcasting, ticketing, all the way down to like CPG products, things that are sold in the fan shop or in sports adjacent venues. So our firm, we invest up and down that sports asset value chain, create a smart portfolio. And what we look for is we look for growth stage companies. So typically that is like a series A and beyond. So these are established companies, post revenue, most likely profitable or really at that edge of profitability where they're looking for cash to buy out a competitor, get into larger sales deals, buy more merchandise for holiday season, right? They're at that inflection point of where they're looking really good, but to get it to that next level where they're above the competition, they need an influx of cash or specialty. And so that kind of eliminates more the VC side because we're not going to do a pray and spray. And it eliminates for us the PE side because we don't want change of control. We want them, the team that's doing well, to maintain control and keep doing it. But what we do is we actually deploy our management team. So, kind of side saddle to our fund, we have something called Champion Management Company, which literally deploys in and we help them with marketing, we help them with biz dev, fractional leadership, all the way down to like 3PL. So we're looking like shipping and other things that we can do to help them elevate their product and get it out to market. So we know the business of sport and we have a lot of connections in there because our entire team is built up of former athletes, people who are sports executives, former sports executives. So it's literally we help the company scale by making a text. So we put our capital to work, text somebody, make an intro, get them in, help them run it.
Wow. So much there, Nick. I'm actually fascinated because I've been reading. I mean, obviously, I know what VC is, and I've been really immersing myself in the PE game. But the fact that you guys are towing the line between the two, I guess one of my first questions is how do you delineate someone who's in pure VC mode versus kind of ready to transition the gap, but also not ready to maybe go into that PE world where now there's that lack of control and they're selling out and there's all these things going, you're trying to play the EBITDA game.
Yeah, it's more so on the company profile. So what you're going to see is a lot of the companies in sports in particular that are looking for VC capital, they are ones that are pre-revenue. They have maybe a couple contracts with like the NFL or like a Caesars or an MGM, they have a big contract in hand. And so they need cash to basically further those and get them going. So they're pre-revenue, they're just getting started, they have a great concept, but now they need some cash to turn on the ecosystem. So you see a lot of those. And I would say we probably get pitched maybe 50 to 100 companies a month like that.
Oh, a month. I thought you were gonna say a year.
Oh,
Oh, wow.
no. I mean, you'd be shocked at the amount of emerging tech and emerging things that are in sports. Far more than people realize. And that's why it's so hard to get into play that unicorn game. I mean, I could literally spray across 100 companies a month if I really wanted to, but that's horrible fiduciary skills. But you could is the point. And so if you kind of let the natural course of company growth, M&A activity, and I would say just kind of business acumen shake out its normal course, it's like being more downstream on like a gold pan expedition.
Sure.
You can be right at the front of the mountain, and sure, you might get some huge piece of the gold, but I think by and large, you're gonna have a lot more days coming home empty-handed. Versus I'm sitting there downstream, sifting and finding the best of the best.
What's your, sweet spot then, your perfect avatar in terms of, top line revenue or even EBITDA?
Everything's a little different depending on which vertical in sports they are. But I would say it's more so not an EBITDA line, but more so looking at recurring revenue north of 1 million or breaking the edge of profitability. So our average check size is between 1 to 5 million. So depending on their company valuation, and you can kind of back into then maybe where they're at for top line revenue. We're probably taking anywhere from a 5 to a 35% of a company when we're participating.
So you're taking 5 to 35%. What's your exit then? Because you mentioned fractional management and things like that. Is that a layer that's kind of, insistent to be on top, or do you just purely lend out cash?
Well, that's a great question. And so this is why we actually are splitting the line between PE and VC. So I promise I won't be on my soapbox for too long, but what's interesting is what is athletes are exposed to for investing. And so we really formed this platform because number one, athletes see very high risk deals. It just, their brother, sister's college former roommate is starting an AI company in their basement. So they want this athlete to invest. And it's like, no, it's not gonna work. Absolutely not. But that's the deals that they're shown. And they've been left out of the meaningful ownership conversation. It's always somebody else who's owning the teams, owning the leagues, other pieces. So we wanted to drive with an athlete first mentality. What's funny about that is the athlete first mentality also goes then all the way to the non accredited investors. It's the mom that is buying a $500 bat for her kids and still driving them to and from baseball games. Like that's literally the same kind of avatar, if you will, of the investor type. Because an athlete, once they're post sport, may slide to a non accredited status. And so we said, how do we cater to a non accredited investor? How do we provide more liquidity options? How do we make this thing hum? And so that's how we designed this ecosystem that we have. So, quick highlights: we don't charge an interest and carry. We're not a 2 and 20 fund. We, as general partners, have put our money into this just like our LPs, and we did it in a C Corp. So, we're a holding company firm. So, people are buying stock in our firm, and our firm then owns the assets underneath. So what that allows people to do is they can buy, sell, and trade their shares on demand, peer to peer, on a secondaries platform, or they can actually sell it back to the company during redemption periods. And so we have semi-annual redemption periods where people can liquidate their entire shares if it's under the whole fund's cap. So what that means is we're taking what's known to be a fairly illiquid asset class in sports, and we provided liquidity options for it. And then we've de-risked it by doing more downstream investments. And because of those, and it's a stock play, we can allow retail and non-accredited investors to play with us.
Okay. You can see, audience, I'm taking tons of notes here. You said something, Nick, like 30 seconds ago that maybe shouldn't surprise me, but it does. In that a pro athlete that finishes their career, a lot of them slide automatically into non-accredited status. That kind of blows me away with pro sports because other than the obviously heavy paycheck that automatically makes them accredited, the fact that they don't meet accredited status means they don't have that liquid net worth anymore. Like, do you see that a lot?
Often, far more often.
Man,
I would say good, probably 70%. And the reason is because most of the time athletes don't choose when they're done with sport. So only if you think about when people retire from sports, it's always a name that you can remember, right? It's always somebody who is top of
Hall
their
of Famer.
yes, exactly. If you think of like a team right now, you can probably name the top 3 players on a team. Not a lot of people can go all the way down the bench, all the way down through the third string, all the way down to the practice squad, right? All those individuals, they may be getting a multi-million dollar check today, but keep in mind they're paying out their agent, their FA, taxes, their estate, everything else on top of it. And so if let's say they get injured, that literally goes away the next day, all of it. So you go from millions to saying, what am I going to do? You may not have had a degree. You may need to reinvent yourselves. You're transitioning out of sport, finding what your job is. So now 2 years go by and you haven't had a paycheck and you've been pulling down from that, what you had previously. And so before you know it, they're no different than any of us off the street.
You know, man, I what comes to mind right now is Alex Rodriguez, right? A-Rod. And I saw him speak last year. Great speaker. What I didn't realize is that, I don't know, 4 or 5 years into his career, very, very early, somebody gave him some advice that said, the average baseball player is only going to be, 7, 8, 9 years. Start investing in real estate. So he started buying duplexes, not realizing that he would have decades long of a career.
Yeah.
And even to this day, I mean, that was a year or two ago. And I think he was up to 10,000 units that he owned, like just craziness. And that's a superstar there, Hall of Famer, having the foresight and being given that information. But 70% are not accredited of former athletes. Like that is, again, I'm just blown away.
Man, it's probably shockingly more than that. That's a rough estimate from the hip for me. I mean,
Of
and if,
course.
if
Yeah.
we Googled it right now, I bet it's way higher, unfortunately.
Yeah, I mean, you can just imagine what you see on social media, and then again, surrounding and just the money is flowing. So of course, it's coming in and out. Yeah. So it sounds to me, and I know this from reading your bio, that your perfect avatar and investor. It seems like they are former athletes. Maybe tell us a little bit about why that is.
It's because that we wanted to provide meaningful ownership in sport. These men and women have given their entire bodies and lives to their sport, but there's very few opportunities to invest and own in it. I mean, if you look at like some of the greats, like Tom Brady recently just bought into the Raiders, right? But to my knowledge, there weren't any other sports investments that he did. So even the folks that are top of their class, they're Hall of Famers, they still just don't have access into it. And so it's kind of if you think about who can write a check to buy into some of the teams right now that are valued at multi-billion dollars, there's only a handful of individuals in the states that can buy into that. And then on top of
Right.
it, few hundred that can worldwide. So to that totality, then they're looking at what other things can we get involved in, and it may be just charitable organizations. It may be their involvement and ownership in sport. Maybe just owning a sports league in their local town. It's not true meaningful access and ownership in the games and sports that they played and love.
Yeah, I mean, when you think of people, even high profile athletes, you hear about them buying restaurants. You hear about them, like you said, investing into and being pitched constantly. And I never thought about that, but the lack of financial awareness of not to invest in a buddy's startup because you happen to have been wealthy while you were a pro athlete. I'm sure that happens more often than we would like to think.
Absolutely. I mean, we're talking daily. And what's funny too is, you said people may be investing in restaurants or real estate. It's because they know somebody who's invested in that. But even what's funnier is we've all lived through 2008, we lived through 2020, so real estate can have some big ups and downs. And so the biggest thing that I would stress is diversification, right? So if you look even at our portfolio, we diversify into sports real estate. That includes short-term rental units around the stadium itself, like a smart city, kind of like the Braves have down there.
Sure.
So each one of those verticals that we invest in are different. And so it kind of provides a lot more diversity in the portfolio and then also more recession proof that way. If you run into anybody's like, put all your money into real estate, I'd be like, holy crap, you clearly didn't own a single ounce of property in 2008. It's one of those things where sports is so diverse and it's also outperformed the markets for the last 60 years. And it's about just shy of a $3 trillion asset class. Yet nobody's there. Nobody's playing in it.
So are you running this kind of like a fund where there's certain percentages into, I don't know, reoccurring rev on sports medicine and then high performance, I don't know, I'm just picking stuff off the top of my head, supplements, and then all of a sudden medical facilities, and then you've got I don't know, Airbnb close to stadiums and stuff like that. Like are you guys choosing, or what control does an athlete have when they're investing?
You are 100% spot on. That's exactly how we do it. And so, because we are really good operators and know the business of sport, we've also brought alongside and hired some of the best operators in each one of those respective verticals. So, we do the picking. It is a blind pool working with us. But the nice thing is, once we do have an asset that we may not take down the entire thing, like for instance, we're looking at I won't disclose right now, but we're looking at a very high profile soccer club over in Italy. So if we're into that, we will not write the entire check for this. So what we would do is anybody who's one of our LPs who has invested with us, let's say we have a high profile soccer player, we'd pick up with them and say, hey, we're putting money into this. Make it up. There's 2 million left on the table. Do you want to do this? And so we would then kind of help them do a direct investment. So not only do they participate in the diversified pool and trust the managers that are there, so then they don't have to have that headache. But then when we see a good deal, we'll tag them on the shoulder and pull them in along with us.
Wow. I can see why it would be very attractive for a former athlete to want to gravitate towards, again, giving back into sport, investing in sport. Kind of, it's like a real estate guy is not going to, like myself, is not going to want to invest in something else unless I truly know about it and feel comfortable.
That's right.
And anything in sport, I think somebody can just identify it with, especially if you, like you said, you've given your whole life to it.
That's right. And the only other downside is that there's the shiny penny thing of it, right? They're like, oh, you know what? Like, let's go back to Minnesota and Canada. I'd be like, oh man, I want to. If this is not on the table, but let's say you want to invest in the Minnesota Wild because you know what, we want to compete against the Jets. Great. You know what? Unless you know the business of hockey, you probably shouldn't invest there. You probably should trust in the manager or know a manager who does that, because otherwise, you're not going to know how to guide the financials to make that happen.
Yeah, no, for sure. I run across a lot of investment firms and things like that. Do you only work with direct, I guess, B2C type thing? Do you allow other funds to invest in your fund? Like, how does it, I don't even know if I'm even making sense in speaking that because I'm so naive about that
Oh,
world.
no. No, that makes so sense. Yep, we allow institutional investors and other funds to participate. And actually, this is jumping ahead to a pretty cool offering. At Super Bowl this year, we'll be down there and doing a very big announcement for us. So we are officially opening up the first evergreen fund in sports history. And so, kind of how this works is, like I said before, all retail investors. So that mom who may be super happy and love sports, instead of playing on DraftKings, they can actually invest alongside some of the biggest names in sports that are in our capital stack. So the evergreen fund, it can grow from 500 million to a billion to 5 billion. There's no cap. So that thing is going to keep appreciating over time. And again, it's a stock appreciation play. Same rules apply for liquidity, but this makes it so that anybody with 500 bucks can come invest alongside it. So we're launching that, and that goes live right after Super Bowl this year. So to that end, we allow all investor types, whether that's a fund, an institutional investor, a retail investor, or a credit investor, can all play.
Wow. That is huge news. I mean, I don't even want to ask. I mean, are you going to try to advertise in and around Super Bowl? Because, I
Uh,
mean, those ads.
Not at the ads themselves, no. But we actually have the week of Super Bowl. I think we have 5 events that we're going to, and we're participating in the
Okay.
NFL Trust, the NFL Alumni Association, Players Association. So the word will be out. And what's great about this too is this year it's in New Orleans, and my business partner, my founding partner with me in this fund, is a guy named Marcus Colston, who played for the New Orleans Saints for, he'd kill me if I got this wrong, 10 years. Um, so, going down there, making this announcement in New Orleans for him, playing in New Orleans is a really good, feel good opportunity.
Yeah. No, this is amazing stuff. Speak to me a little bit about your work with the sports teams. I know being a Colorado guy and stuff like that. I mean, you mentioned obviously the hockey teams, but in what capacity?
So when I worked with Cronky Sports, I worked with the Avalanche, the Nuggets, and the Rapids. And when I worked with those teams, I would do kind of like I talked about at the beginning of this podcast was, talking about physiology. So I'd go in there, I'd help them assign heart rate zones, look at their total workload. And then basically I was there for the coach's eyes and the medical staff's eyes, and kind of in between your coaching a straight team and the medical team, to really say who's at injury risk, where do we go, how do we make some nutritional advice for these athletes, and how can we make sure that they stay healthy throughout the entire year? Of course, people are going
And
to
is
get
that
banged up.
with
That might happen, but other than getting banged up, how can we make sure they're not fatigued or getting injured while on the game.
Okay, and was that with any kind of sports tech, or is that more from a traditional health perspective?
All the above. So we use different heart rate monitors. We used motion sensors. Um, we measured velocity. We measured force output. So we did a lot.
Okay. You've been a high performance athlete, and I'll preface by saying when I'm hiring an employee and I see high performance, any kind of training on there, I mean, I will actually gravitate towards that because of the discipline it takes to and the drive it takes to excel. How have you found between yourself and the people you surround yourself with that high performance mentality? How does it translate into business?
It is one and the same. And I would say we have just shy of a couple dozen people on our team. And all of us have either been in the high performance realm, former athletes, current athletes, or at least just know that teamwork ethic and have worked around sports. And there's just nothing that replaces it. So once you have that drive, have that push, it's the same thing of not ever taking a loss in business. You're driven by wanting to get a win. You're driven by having teamwork, and you're very self-sufficient and very self-motivated. So taking it from you, when I see that on the resume, I absolutely gravitate towards them because I identify with it. I've experienced it, and it's never let me down, honestly, in hires.
Yeah, no, it hasn't with me either. I think again, athletes they don't know the word no.
That's right.
You can't tell them no, you can't tell them you can't do this. So if you can point them in the right direction with the right resources, it doesn't matter whether, I don't know, they don't know how to type. They're going to learn in 2 months, two weeks, and they're just going to all of a sudden be typing 100 words a minute because they're just used to taking something and then killing it,
Yep.
right?
Just hardwired different.
Yeah, no, for sure. Um, sorry. So when you talk about diversification as a strategy, speak to us a little bit more about why it's necessary. Like why? I mean, you're already kind of diversified outside of the more traditional things. Why diversify within a diversification?
Ooh, great question. Because even in sports, you need to build a resilient portfolio to any economic downturns, changes. We've lived through it. We know how things work. So what's great about diversifying it is sports adjacencies and the thematic investments in sports really encompass a lot of different markets. So we talked about real estate in the sports vertical. Think about media and broadcasting rights. That's a massive one right there. When people couldn't fill the stands during COVID to go to a stadium, they sure were paying attention to media and broadcasting rights. It was skyrocketed. Same thing with like memorabilia sales. They went through the roof at that time. So if you diversify across each one of these kind of verticals across sports, so call it sports real estate, medicine, tech, fan experience and engagement, down to actual high performance itself, each one of those verticals, the totality of them makes it very recession proof and very resilient.
I think I mentioned in the green room that I've recently started. It's more of a passion project too, as is this podcast. But I'm interviewing former pro athletes because you just mentioned, and I just had a Laurie Boschman, ex Winnipeg Jet legend, on the pod last week, and I mean he describes that it's just not easy, right? Whether it's from an injury or you make that decision in your mid 30s or whatever your sport might be, just to okay, I'm done. It is literally like you said, like you're on the outside looking in. It's really really tough when you now talk about that translating into finances. How would you walk somebody through that? Like, assuming that, like, how did people even find you? I mean, what's your marketing strategy for finding a pro athlete? Is it word of mouth?
Well, I mean, my marketing strategy is we got a damn good marketer, so that helps us a lot. And it's not necessarily me, but more so, uh, it really comes down to a peer to peer mentality. You really, if you want to talk to business of sport and you really want to attract athletes, you need to be an athlete yourself. Can you be somebody else? Sure, but you need to prove to that person why you're there and what you. If you are a former athlete, you know exactly how it works. It's a lot easier to kind of cultivate a cult following and bring them around you. So it's just kind of the finding your tribe, right? I mean, so it's peer to peer, it's word of mouth. It's marketing, but the marketing is really set to kind of point towards direct individuals or using individuals who have been part of this before to kind of amass, people to join.
No, for sure. How do you see your firm kind of breaking down those extra barriers? I mean, I know you mentioned the evergreen fund. Are there any other initiatives that you're finding to try to really get awareness for what you guys are doing?
Yes. And so actually one of our arms through our management we actually are going out there and providing financial education and literacy services. And so doing
Uh,
that with athletes, we're responding to RFPs across the big leagues to really teach athletes financial education. And so that goes a long way because not only do we then have an outlet where they can invest, but more so it's back to what I said before. It's just doing good things and the money will follow. If we can teach others, they can be more empowered to what they do with their finances once they transition out of sport. And I think it's naturally going to gravitate and shift the landscape of financial advisors and people who are working with athletes to work on the athlete's behalf and when they're transitioning out of sport versus just capturing the AUM right now while they're in sport.
how early do you have to get to an athlete? I mean, you think about that, right? I don't know, high performance teens, high school, college, junior, whatever sport it is, and all of a sudden you're drafted. Now you go pro. Now you're going on a farm team. Now, I mean, it's so busy. At what point do you think is the sweet spot to try to permeate that, financial literacy for what's going to happen, which could even literally be, an ACL tear in year number two?
I don't know if you're going to like my answer because the answer is anytime. Because at the end of the day, everybody's got a guy for that, right? If you're
Yeah.
a kid who's in high school, but you're number one in your state, I already guarantee you have an agent, you have recruiters, you have people looking at you, you're working on your NIL deal. You already have a guy for that, right? And so they will tell you from the day they start with you to the day you transition to a different person, or maybe you don't, they have your best interest in mind. So it doesn't matter when we come to the table. It's literally showing them more and educating them. I don't care if they are literally 80 years old and part of a Hall of Fame class from, long time ago, or if they're 18 years old and they're a future Hall of Famer. Maybe they're not even. Maybe they're like already like, hey, I'm just using sport as my tool to pay for college to become a lawyer. Great. That's totally fine. Now let's teach you where to go with this. So there is no ideal spot.
Wow. I run my companies with bigger purpose in mind, obviously in housing and trying to affect homelessness. And I really truly love your bigger purpose because I think you're doing a lot of good in an industry where people do suffer. I mean, the careers are so short. I'm going to transition that because we're wrapping up here into a question that I like to ask every guest, and I want to hear what you have to say. So, Nick, this is the Investing to Win podcast. How do you define success and what does winning look like for you?
Ooh, that is a massive question. Winning to me, I'm going to answer it in reverse. Winning to me is not working with thousands of people anymore. It's working with millions of people. I want to make sure that millions of people can get the message and leave a legacy of exactly what they can do owning in sport and owning and controlling their own finances. Success for me personally, it's a generational play. So I would say it cascades across two things. First, for me personally, I'm not doing this for me. I want to do things for my children. I want to do things for my family, and I want to create a legacy going forward. And so if I do my job right, success to me is having my kids have that instilled in them so they go out and help others.
Love that. Well, that's a fantastic place to stop. Like I said, we could go on and on and on. I mean, I had to stop myself here because I'm so passionate about sport as well. But thank you so much for coming on the podcast. I can name almost like 5 or 10 people that I want to introduce you to, which we'll talk about after, because I think it'll open some doors and help you reach your mission.
I would love that. Thanks for having me on. We should do this again.
All right. Thanks, Nick.
Thanks. Appreciate it.